Hello, everyone. I'm Alex Salvo, Business Development Director here at Lane Trubit. Thank you so much for joining us. Whether you're a familiar face or joining us for the first time, welcome. Joining us today is Lane Carrick. He's a seasoned M&A advisor and instructor at SMU, Cox School of Business. And I'll let him tell you a little bit more about himself. Welcome, Lane.
Alex, thank you so much. Thanks to you and Darla for having me as a guest in your offices a few weeks ago, and for the webinar today. I'm honored to participate. And I am an M&A advisor. I do teach at Southern Methodist University, as you said. To the surprise of my daughter, who's an SMU grad, I followed her to SMU, followed her to Dallas, and then lecture on mergers and acquisitions and alternative investments in the executive MBA program there. I've been working as an M&A advisor, a sell-side advisor for business owners, typically with businesses valued from 10 to $100 million. The significance of that is that they're usually selling their businesses to institutional buyers, private equity firms, family offices. And what I found is there's a real mismatch between the knowledge and experience of the buyer and the knowledge and experience of the seller in terms of a business, of the sale of a business. The founder, owner, operator may be great at manufacturing widgets, but if they've never sold a business before, they're pretty well outgunned by a private equity firm that does nothing but buy businesses. So I've been working as an advisor. And ultimately, that led to the publication of the Optima Advantage, where I sort of captured my process and systems for business owners, telling them what that process looks like, sort of starting with the sellability assessment. Do they have a sellable business? So that's the world I operate in. I am a sell-side advisor working with founder, owner, operators selling their businesses to typically private equity firms in probably the most significant financial event of their lives. And appreciate the opportunity to share some of what I've learned and talk about how to maximize the business before sale, which is the topic of today's discussion. A lot of times, I kind of function as an emergency room. People show up on my doorstep and they're tired, they're going through a divorce, they're ready to retire, and they're eager to sell their business. And sometimes we discover they don't really have a sellable business. So, I kind of start with, do you have a sellable business? And if you have the time and capacity to invest in sort of fixing it up, I use the real estate analogy. When I sold the home that my wife and I'd raised three children in 10 years ago, the real estate agent came and said, you need to replace the carpets and the drapes, you need to cut the grass, and so there were things that
Work.
needed to happen for that house to be prepared for the market. And I would say that when you have an operating business, a lot of times it's hard for you to see that the drapes are tired and the carpet needs to be replaced. With that, if
Yeah.
it's okay, I can move into the presentation itself.
Absolutely. Yeah. And one thing I will add is that he's also a co-host on a podcast, the Deal Table. Wanted to throw that out there. I thought that was he's had some interviews with some very, very interesting folks. So I would definitely check that out if this is a subject that's close to you and this is something that you're looking to start exploring. So I'll from there, what I'm gonna do, just so that the audience is a little bit aware, I'm going to lean on his lecture presentation skills and ask questions as they come up, whether they're from myself or from you guys. Like I said, we want this to be super interactive, but towards the end, we'll have 15 minutes of discussion, a little bit of Q&A. And so, but just with that being said, Lane, please take it away.
Thank you very much. I think I probably talked enough about myself. Thank you for throwing in the deal table. I think we're 50 episodes in now, Alex, and we
Wow.
film it on site at Old Parkland, which is a very unique sort of entrepreneurial lab here in Dallas, the creation of Harlan Crow. And so our podcast is a little unique because I'm interviewing people that are somewhere in the M&A ecosystem, and we're doing it in person on site in the pig room on the Old Parkland campus. And I guess I would say that as a backstory, I have built, owned, operated businesses and sold them, including selling to private equity. I realized after my first transaction, after I had a few years to process that first transaction, that I wasn't a great M&A advisor to myself, and I didn't use an intermediary. So I think part of my role as an intermediary was born by realizing that even though I was the chairman of a bank and a wealth management firm and operated businesses, I was out over my skis when it came to the process of maximizing value in the sale of the business. Um, what we're looking at right now, Alex, is there is a wave coming ashore of privately held businesses. We're at a level of historic transfer of privately held businesses because more than half of the businesses in the United States are owned by people that look like me. They're typically male and they're over 55. I'm solidly over 55, and and they are going to either sell their business or close their business. The options are somewhat limited. You either find a way to transition the business to the next owner, or you close the doors. And so you can see that my generation, the baby boomers, are falling off a cliff here. It's really steep and depressing to look at, right? There were 79 million of us in 1999. We're down to about 65 now, and you can see the how this plays out over the next 10 to 20 years. So there is
Okay.
going to be a significant transfer of privately owned businesses. How that plays out will be interesting to see. We actually have a lot more baby boomers than the generation that would be the logical buyers of those businesses. So it's possible we're going to have a bit of an imbalance where we're going to have more businesses looking for a buyer than we have buyers looking for businesses.
Wow.
This is the fundamental issue that we're facing is this historical transfer of businesses coming from baby boomers like myself that are exiting, and those are the people I represent. And yeah, I think that the reality that most of those owners have never heard is that most businesses don't sell. And I can't emphasize that enough. And I've kind of learned that through the experience of being an intermediary the last 5 years. I think we kind of make an assumption that if we own a business, and particularly if that business is profitable, that when we're ready to sell, there'll be buyers lined up ready to buy it from us. And the experience that I've had, I started Optima about 2.5 years ago, but prior to that, I worked for one of the largest M&A firms in North America by deal volume. And before that, a local M&A shop that was relatively high volume for a small boutique. And what I saw was about a 20% success rate in people that hired an intermediary, packaged their business up, and went to market. Only about 2 out of 10 of those business owners actually successfully transacted. And that's kind of staggering. I mean, think about the real estate analogy that I use. Think if only 2 out of 10 people that owned a house that put it on the market for sale actually got a transaction. This is a pretty staggering statistic. And the reason for that, a lot of it is grounded in unrealistic expectations. I don't know where business owners, get the data that tells them what they think their business is worth, but I can say almost universally, business owners have unrealistic expectations about their business. Maybe it's confirmation bias, right? Maybe it's they turned on the news and saw that SpaceX has made Elon Musk a trillionaire, and they think, well, if his company's worth, X times X, then my company should be worth that. So maybe there's bad comparisons going on. Maybe they're just getting information from other sellers that may not be accurate. But the bottom line is that one of the toughest battles I fight is when I engage with business owners up front. The first thing I do is a fair market value valuation that looks at where other businesses like theirs, their industry, their geography, their size, have actually transacted over the last couple of years. And almost 100% of the time, it's a disappointing number to them. They just have this belief that their business should be worth a lot more. I had a plumbing contractor several years ago that came to me, and his business was doing about a $500,000 of annual profits. And I said, how much are you expecting to get for your business? And he said, 20 million. And I said, well, that's, that would be, 40 times your annual profits, and businesses like yours, typically don't trade at that level. How did you come up with that number? And he said, well, one of my competitors sold for $10 million, and I have twice as many trucks as he does. So it was the truck comparison, right, that
Right.
he had anchored into that just gave him a really unrealistic expectation. Owner dependence is a big issue. A lot of business owners are type A. They're used to running the business. They don't want to delegate because they don't think anybody can do it as well as they can. And the business ultimately is the owner, and everything bottlenecks with the owner. And a buyer is concerned that when that owner walks out the door, the relationships are going to leave. The systems and processes are in his head or her head. Weak financial reporting, certainly something dear to the hearts of accountants on the call. If you don't have good books and records, then your buyer is going to be uncomfortable. And more importantly, your buyer's lender is going to be very uncomfortable. And that can certainly kill a deal. Customer concentration. One of the first clients I represented had a 100% customer concentration. Walmart was his client. That was great, but there was no contract in place. And if Walmart canceled, stopped doing business with him, he had no business. Lack of management depth. Again, a lot of times with very strong owners, they don't bring in, a bench behind them. The diligence issues, all the things that can come up, once the buyers, made the commitment. What happens after that, and is the story they're being told, the financial information they're being presented, does it match up when they start the diligence process? So, here's 100 business owners, 30 consider selling, 10 go to market, maybe two or three successfully close. That's the math that sellers are fighting. Um, Profitable businesses are not necessarily profitable businesses, and sellable businesses, excuse me, are not necessarily the same thing. Owners look at their business, and they look at the revenue and the profitability. And oftentimes, when I engage with a seller and I ask them about their business and I ask them about their expectation on value, they start defining it in terms of how many years they've run it, how hard they've worked. I haven't taken a vacation in 10 years. I've poured my life into this business. And we built a great reputation, and I have these relationships with these customers. And unfortunately for them, that really doesn't inform the buyer's position. The buyer can be empathetic and appreciative of the fact that the owner's made a lot of sacrifices, but at the end of the day, they're looking at the risk. What's the risk of buying this business and operating it? Is it transferable, or has the owner just built something that's completely dependent upon them? Is it scalable? Can I grow it? What are the quality of these earnings? And we'll dig into that a little bit more going forward. But the key point is that sophisticated buyers look at a business through a completely different lens than the owner does. And the owner, a lot of times, sort of anchors or conflates value to sacrifice. And unfortunately, a buyer and the buyer's lender, are looking at the cash flow, and so there's sort of an emotional disconnect, that can happen. I see your poll up there.
Oh,
Should I
good.
answer? Should I answer the poll?
Well, maybe we can reveal the results.
Okay.
We'll
Do
see
you know
what
the
they
current
say.
market value of your business? I would bet that a very small percent actually have had a recent valuation. I don't know the makeup of your of our group on the call today, but
It's a good
boy, I
mix
don't.
of accountants, controllers, CFOs, and a couple of business owners.
Okay, that will be interesting.
All right. Well, it
Should
looks
I
like
move?
no, not really is what the poll looks like to be winning. So there we go. Okay. So
No,
yeah,
not
please
really.
feel free. No, not really. Interesting.
Okay. All right. So let me see. How do I move forward here? I've lost my arrow. There it goes. Okay. So Did I skip one? I did. All right. So what sophisticated buyers actually buy? They're buying future cash flow. They care about the backstory. They care about the owner. They care about the employees. They care about the customers that are being served. But at the end of the day, most buyers are financial buyers, and they're paying a multiple of the cash flow. And they're interested in future growth. Particularly in the market I serve, which is again that 10 to $100 million enterprise value business, because the buyers are typically private equity and family office, and they are not looking to just milk the cow. They're looking to build a dairy farm. They're looking to buy the business and then expand and grow it. And so if they see a platform for expansion, that's really attractive to them. They want a manageable level of risk. They understand that an operating business has risk, but they want that to be manageable. And they want a return on invested capital. That is going to inform and drive their valuation. I'll tell clients, look, if you sell your business at a 4 multiple of your earnings, and the buyer's buying your earnings, and if he or she can maintain that earning stream, and they pay a 4 multiple, they're basically getting a 25% return on their investment, right? They invest $1, they get a 25-cent a year cash flow. What return do you expect if you're going to buy and operate a small privately held business? What return do you expect? If you can put your money in the stock market and make 10 or 12% per year on average, what return do you require to buy a small privately owned business with all the risk associated with it? The answer is, if you're a private equity firm, you're looking to make a 30, 40% internal rate of return on your invested capital, so that you can pay your investors, and make a return for yourself as a firm. So that really sort of puts a box around the valuations. I think a lot of sellers don't really think about it from the perspective of, how are they coming up with the purchase price? They're looking at cash flow, growth, expansion opportunities, risk, return. Owners are thinking, well, I've really worked my butt off for 20 years to grow this business, and I've developed these relationships, and we've earned this reputation, and I've got a legacy. And again, all those are sort of emotional things that resonate with the owner, may be meaningful to the buyer, but they don't inform the transaction itself and the structure of a purchase. They also, if you sell the business for what it's done, then you're going to be limited. If you can show them that path to growth and expansion, then that creates the opportunity to get a higher purchase price. So the 4 things the buyer's looking at, they're looking at the cash flow quality. Can I trust the earnings? They're interested in seeing accrual versus cash accounting. They're interested in looking at the non-recurring items, that are hitting your income statement, that may be one-time, gains or charges, so they can normalize the earning. They're looking for the sustainability of those earnings. Okay, you had a great year last year. Is that sustainable? Or was there something that happened there, that was non-recurring? They're looking for the consistency of that free cash flow. They're looking at the CapEx. I had a business last year where the deal fell apart because the business spent about 50% of its earnings on CapEx. So it was a very capital intensive business. And the owner, had suggested that he was grossly overspending on CapEx, and that was sort of part of his narrative around his business. Was I have chosen to really invest in capital items that a new owner wouldn't have to do. When the prospective new owner did his homework, he concluded that no, that CapEx is actually, a recurring item, and so it changes, our perspective on the cash flow. They're looking at the risk profile. What's the competitive threat? Is there a moat around this business that protects it? Or is there something going on? That same owner that had the CapEx issue had a major competitor that had stayed out of his market for a long time on kind of a friendly handshake deal. and that business transitioned to that owner's son, who then decided to come into his market and compete against him. So he was trying to sell at the time that he was about to pick up a major competitor. And those things, one, you need to disclose. Those are material items, and you're going to be repping and warranting, certain information. It's also going to come up in diligence typically. Operational risk, supply chain. We can just say COVID and kind of leave it at that, right? We can talk about tariffs. I have
Yeah, the hot topic.
yeah, I have just an absolutely fabulous construction company in a niche market that's been doing business with Fortune 500 companies for 25 years as their go-to construction company for their retail boxes. And I couldn't give them away last year. The effect of the tariffs on the supply chain and pricing just created so much uncertainty over their future earnings, that they were not sellable. Nothing to do with them. It wasn't a situation they created. Financial risk. What's the company's financial position? How is it capitalized properly? Scalability. Again, this goes back to your ideal buyer is looking at you not just for what you've done in the past and putting a multiple on it, but they're looking at, can they grow the business? What are the unit economics? Looking at operating leverage, fixed versus variable costs, systems and processes. And they want those systems and processes to be captured in the business, not in the owner's head. If the systems and processes live in the owner's head, that's a problem, and it's going to get discounted in a transaction. Growth potential, we talked about that. Where does it come from? Is it acquisitions? Is it geographic? Is there something going on in terms of innovation? And so this is the lens through which the buyer is looking. And for every diligence question, every valuation discussion, every negotiating point ultimately comes back to one of these four categories. Can I trust the earnings? I've got two transactions that you're aware of, Alex, that are large transactions for me. One's at 75 million, one's at 95 million. They're actually being bought by the same company who's doing a roll up. And they engaged Houlihan Lokey to do a quality of earnings analysis on each of those companies. I would suspect, given your audience, they're probably familiar with the quality of earnings analysis and sort of the intensity of that. What I would say is that when we went through that process, and these companies at this size, they have very good books and records. They're audited. They're strong. They're not sloppy. But in one case, the quality of earnings came back and said our client that had shown $12.2 million of adjusted EBITDA, they argued it should only be 9.4. We had a 7.5 multiple. We had a purchase price that was 7.5 times adjusted EBITDA. So the difference between a 12.2 EBITDA that we were presenting and a 9.4 that came back through the quality of earnings was a $21 million negative adjustment in purchase price. Now, that didn't happen. We were able to argue, that there were inaccuracies in some of their assumptions. The other one started at 12.5 million and they came back at 11.9. We ended up settling in the middle on that. But this consistency of profitability, there were issues over that. They had a very good. Each of these companies have perform a service that is affected by weather, and they had a very good weather year in the trailing 12 months over the previous 12 months. So the argument was that that wasn't going to recur, that the normal weather cycle would produce smaller earnings. That's the kind of thing you're arguing when you get into this level of, this size of transaction.
Right.
Is the financial reporting reliable? Are the margins predictable? That strong cash conversion kind of goes back to the CapEx and other items. How much of that cash flow is getting to the bottom line? Here we go.
Another poll.
PPE. Which of these do you think matters most to the buyer? It's a good question.
Which was, yeah.
I will say that they value each of those, but not equally.
I I would that'd be a tough one to answer. You'd think all, but I mean, they probably are all, but
They
it
are
sounds like
all.
way
I would tell
different.
you that one of them is probably dominant and supersedes the others, but yeah,
Mhm.
they're all important.
Well, it looks like cash flows in the lead.
Cash flow should be in the lead. You can theoretically solve for customer diversification, management depth, growth potential, but if you got poor cash flow, that buyer and seller aren't going to come to an agreement over valuation.
Right.
So, all right.
All right.
So
Awesome.
common sources of what could go wrong in the deal. Customer concentration, we talked about. Generally speaking, I would say if one customer's, if they're over 10%, you start getting some pretty tough questions. There you go, 53%.
Yep.
Growth potential, 33. Interesting. Um, over 10%, you start getting a higher level of diligence. If you're at 40%, you've got a serious issue.
Hmm.
Owner dependence, a lot of the diligence by buyers at this level focuses around what's the role of the owner. And if the owner's touching and feeling everything, then you've got a challenge. I had a deal last year. It was an electrical contracting firm, and as a husband and wife team, the wife kept the books, the husband ran the operations of the business. Um, that's a popular area in the market. So we had, I think, literally 15 offers on the business. So we started having calls. We had a beauty pageant. We got down to the prettiest buyers, and we decided to, put three or four of them on the phone with our sellers to have, an initial conversation. And I remember in the first call, the buyer was trying to get to this owner dependence issue, and he was asking questions to the sellers about what flows through them and can the business function once they leave, because they were going to transition out of the business shortly after closing. And the husband proceeds to tell them that he's so proud the business doesn't depend on him, that he took his wife on a cruise for a week and didn't even think about work. And she immediately said on a diligence call, well, why did you buy that satellite phone and take it on the cruise and talk to the office all day? That was a kind of a short diligence call that didn't end particularly well. But here's an owner who's thinking the business really isn't that dependent on me, but he can't take his wife on a cruise without getting a satellite phone and making calls back to the office all day.
I
That could
bet
be a
that
person.
ride home was really, really a good one. I bet that was
Yeah.
a great ride home for both of them.
Oh man. Um, yeah, key employee risk. I had an interesting situation on a recent deal, the one that closed last week. The seller had some key employees, and he wanted to give them $1 million. There were three key employees that had been with him a long time. They were going to stay with the business with the new buyer, but he wanted to give them $1 million out of the proceeds from the sale to reward them for having been long-term valued employees. Now, you would think that's great, right? One, it's wonderful that they wanted to do that. The family wanted to reward these long-term employees. What do you think the buyer thought about that?
They were probably like, no, no, no.
Yeah, the buyer said, well, if they're key employees and you give them $1 million, are they going to quit? Is that walkaway money for them?
Right.
We'd like to tie a non-compete language to your bonus to the employees. It's like, no, that's our bonus that we're giving to them. It
Mhm.
shouldn't come with your non-compete. So, sometimes you find there's strange bedfellows in this. In this case, they wanted to reward key employees. They did end up making paying a bonus to them, but it became a $500,000 instead of $1 million. Somewhere around there, they figured that was enough money for them to be well rewarded, but not enough for them to walk out the door.
Right.
And there was some non-compete language that they had to agree to accept the
Okay.
bonus. So that's how some of those things go. Industry concentration, operational risk, weak systems, documentations, controls, scalability and growth potential, why buyers pay premium multiples. I will tell you, the private equity world and strategic buyers love recurring revenue. I sold a commercial landscaping firm last year. It's a $36 million transaction with a private equity firm. It's a gentleman that started cutting grass in high school and built a landscaping firm out of it and turned it into something that created multi-generational wealth. He's still there. He kept 20% equity in the business, and he changed his role in the business. But when we took that business to market, there were a whole lot of groups, including several in Dallas, that have platforms where they're doing roll-ups in commercial landscaping. And we reached out to them and said, "What are you paying?" And they said, "Oh, for the right firm in commercial landscaping, we'll pay, 7, 8, even 9 times."
Oh,
Our
wow.
guy transacted at 4.5. The reason he transacted, and it was a good deal, the reason he transacted at 4.5 is because he didn't have any recurring revenue.
Like
He was
service
doing
contracts?
he was doing new installation, for the BMW dealer and when Starbucks built a new store. So he didn't have any recurring revenue. What they wanted was revenue coming from homeowners associations and others,
Property
where
management.
every month
Mhm.
you got this revenue stream you can touch and feel. So in that case, and that's fairly dramatic, but the difference between having a landscape company with recurring revenue model was 3 or 4 additional turns on the profitability. Now, he ended up being in market longer than he thought because there was terrible weather. And right as he went to market, it rained literally for 90 days, and so he didn't have any revenue. So he ended up being market. He started going back to clients and putting recurring revenue contracts in place for maintenance while we were in market, and it probably moved the needle about $1 million.
Wow.
So that's a little unusual. Strong customer retention, not just recurring revenue, but are you keeping those clients? Management depth,
Mm.
repeatable processes, expansion opportunities, additional products or services. The buyer mindset for the average company that's going to get a 3 or 4 multiple, is how long will it take me to recover my investment? They're thinking like a financial buyer. I'm paying this multiple of earnings. How long does it take for me to do that?
Right.
The platform company, the company that's going to get the premium, the question is, how large can this business become? Premium valuations are often driven more by future opportunity than historical performance. Historical performance is the anchor, but you can really juice up the transaction if you have a platform that can grow from. What drives enterprise value? Enterprise value, why do I keep going up and down? Enterprise value is not determined by earnings alone. Buyers pay more for companies that are predictable, transferable, scalable, growing, lower risk. Although I will tell you, if they're growing really fast, that scares people. Yeah,
Really?
no kidding. I have a business that's still in market that had a 40% growth year last year, and nobody will touch it because they don't understand, and they're not sure, and they don't want to pay a multiple at the highest earnings ever achieved by the company if they don't
Right.
think it's sustainable, and we're not able to demonstrate that it's a sustainable growth path.
Right.
Not surprisingly, a lot of business owners come to me when they've just had the best year. Well, they either come when they've had the best year they've ever had or the worst year they've ever had, right? Uh, when they've had the best year they ever have, they want to get paid the full market multiple at the highest number. You know, if it's a smaller business, that'll get funded by the SBA, and they're going to use a formula where they wait the last 3 years to sort of smooth that out. But if you're shrinking, that's a problem. If you're growing too fast, that can be a problem as well. Enterprise value drivers, financial quality, revenue quality. I'm kind of hitting on the same points here. Financial quality, credibility creates value. Yeah, I have a client in market right now, and the latest financial statements we have from that seller is from December of last year, and that does not work in the marketplace. This particular seller just has a challenge, getting her books and records on a timely basis. There are some adjustments. There's some unusual circumstances that are requiring some adjustments. But at the end of the day, when you're in market and you're showing 6-month-old financials, that doesn't work well, and it sends a message to the market as well. That you're not able to produce, timely financial statements. They want to see accrual-based accounting. They want consistent reporting. They want reliable forecasting, clearly documented adjustments, strong internal controls. that forecasting piece is really interesting. I have a deal, the deal that closed last week, where they had just had the best year they'd ever had in the business. And we were arguing that should be, the number and the multiple applied to that. And the buyer smartly said, well, run a forecast for us for the next 12 months. And it's a business that books most of its business a year in advance. So they have a backlog and they have contracts. And so, it's not a wild forecast. It's pretty much predicated on what they can see. There'll be some variance around it. And their forecast was for a lower revenue and profitability year than the number they had just reported that they want paid for.
Yeah, and that's what we tell a lot of our, our smaller clients that we have is if there's even an inkling in that you want to sell in the next 5 years, we need to move each from cash to accrual accounting. And so they're kind of like, oh, is it really that big of a deal? It is. It's a big deal.
It really is. It really is if your buyer, particularly if your buyer is an institutional buyer.
Yeah.
If you have the corner yogurt store and you're going to sell for $500,000, and the SBA is going to finance that deal, then they're not expecting accrual-based accounting. But if you're running a manufacturing firm and
Right.
and you have over $1 million of EBITDA, having accrual books is really important to that
Imperative.
buyer and to that buyer's lender,
Right.
importantly.
Absolutely.
Let's see, less attractive one-time projects. Yep, I just covered that one, and I can speak to that. A huge discount. Transaction-driven revenue, heavy customer concentration, unpredictable sales cycle revenue tied to a single relationship. To the point of my commercial landscaping firm, $1 million of recurring revenue is worth a lot more than $1 million of project revenue.
Hmm.
And if I were, if the people on the call in your firm, you're talking to somebody and you've got that lead time with their business, getting them to understand that to the extent they have any control over having more recurring revenue as part of the mix, anything they can do to get that revenue under contract and make it more predictable is going to translate into a better transaction price. Management depth and transferability. Can the business thrive without the owner? Who makes the decisions? Who owns the customer relationships? Again, my diligence call where the owner's wife ratted him out for using his satellite phone on the cruise ship pretty much told the buyer everything they needed to know about who makes the decisions and who owns the customer relationships,
Hmm.
and who drives sales and who understands operations. If you can't be gone for a week or two or even three, and the business operate without you, then you've got an owner dependency.
Right.
I put in here, imagine the owner disappears for 6 months. That's quite a test. Not a lot of businesses would continue normally. That would be really a more passive business. But a lot of businesses would stop functioning, and they stop functioning long before you got to the 6 month mark.
Hmm.
Businesses that depend heavily on their owners are often harder to sell and absolutely command lower valuations. All right, there you go, Alex. How far out is your exit or succession plan? We'll see how many 55-plus-year-olds there are on your call today. Right? If your audience is all me, then everybody's saying, "Yeah, I'm thinking
I'm
about it.
thinking about it.
Yeah, I'm planning." But if they're all a bunch of, 30, 40-year-olds, then it's probably
I got
going to be,
time.
I hadn't started thinking about that.
Yeah. Okay, great.
All right. You want me to plow ahead?
Yeah, plow ahead.
Okay. Let's see. Uh, Here we go. Operational maturity and growth potential. Uh, uh, Strong CRM systems, KPI-driven management, consistent execution, tech-enabled operations. These are things that really sing to the institutional buyer. From the private equity perspective, the current EBITDA matters, but the future EBITDA matters even more. They will model that EBITDA out, and they they will absolutely apply a higher multiple to a business where they can model out with some comfort a higher EBITDA post closing, where they can, even if they're contributing to that growth, in which they are, they will still pay more, all things being equal. Um, you take two companies with different growth trajectories, and you're going to get different valuation multiples. So again, part of the planning process for business. A lot of my clients think that once they sign the letter of intent, that it's all downhill, right? That all the hard work's done, and one of the things I like to remind them is that, once you sign that letter of intent, you're really just getting started in a, you could call it a sprint. I still think it's more of a marathon. This is typically a 90-day process. It can be faster. It can also be a lot slower, depending upon
Size and complexity.
who the buyer's engaged. So the LOI is typically followed by the quality of earnings review. I just got through a process that was played pretty fast. It was about 3 weeks, but I've also had a 120-day Q of E process that I can't believe we survived it and the deal got done, because that's just, that's really tough. Followed by legal diligence. Generally speaking, the buyer doesn't want to start paying their lawyers until the Q of E shows that the business is what they think it is. So generally speaking, they're not going to start drafting purchase agreements and doing the other things until the Q of E validates what they think. Then they get into the operational diligence, working capital review. I won't dig too deeply into working capital, but I see deals blow up over that. When you own a business and you have $1 million of cash in it, or 2 million, or 5 million, or whatever the number is, and you think that when you sell the business, that's yours. But if the business requires $1 million to continue to operate, then a buyer expects that business to come with sufficient working capital for the business to continue normal operations. I call it the tank of gas, right? If you buy a car off the car lot, you don't expect to drive off on empty and have to pull into the gas station as soon as you drive off the lot. And a lot of arguments can happen over what's the right working capital amount. I had that happen in the deal that just completed last week. When the tariffs hit, they had an opportunity to buy a much longer term supply of a raw material they needed in their production than they ordinarily would. They might typically buy 90 days of supply. They bought a year of supply because they were able to buy it at an attractive price, knowing that prices were going to go up. It inflated their working capital in the calculation of a backward-looking working capital calculation. So we had a nice, robust argument over what's the right working capital amount, and it was a $1.2 million argument, right, over what the right number is. We ended up meeting in the middle, but working capital can be a sticking point. Financing approval, definitive agreements leading to closing. And I will say that from a leverage dynamic standpoint, all the leverage shifts after the LOI is signed from the seller to the buyer. So up until the LOI is signed, we're kind of in control. We're making the buyers jump through hoops. We're pushing them on their offer. And once that LOI is signed, everything after that is a risk assessment by the buyer, and you're not going to get better price and terms post LOI, right? You're just playing defense.
That's a good way. I never thought about that, but you're very, very right. Yeah.
Yeah, all the leverage shifts. So we're just playing defense the whole time, and it creates a really awkward dynamic. And a lot of times the people that the seller's dealing with change. So up through the LOI, the nice guy from the private equity firm is coming down and telling them how pretty they are and what a great business they've run and how proud they should be. And we're making
Taking
this
them to
offer.
dinner.
Yeah, taking them to dinner, buying them steaks. And then when the LOI is signed, all of a sudden, they've got a quality of earnings thing. They got lawyers. And they're just constantly. They feel like they're just constantly under attack, and they kind of are, right? Now, what I'll explain to my client, I had this conversation this morning. They were like, I can't believe they're asking for all this information. I said, they're writing you a $95 million check. If you were writing them a $95 million check, would you require this level of information? Well, I hadn't really thought about that, right? So, there's a price, and there's a reason to have to go back and dig out that agreement that you've got in the safe, and copy it and upload it to the data room, and be happy because it's part of that process. What are they looking for during diligence? They just want to know that they're buying what they thought they were buying. They're looking at that revenue quality. They're validating the EBITDA because we told them what the EBITDA is. They got to go back and crunch the numbers and make sure that it's accurate. They're working through the working capital, the cash flows. They're looking at the key employees, the systems, the processes. You're into all the legal stuff, the contracts, the litigation. We had a 2-hour call yesterday on a transaction scheduled to close next week with a seller, and we and that 2 hours was spent on 25 pages of reps and warranties, just on the reps and warranties in the agreement. 25 pages of things that the seller is telling the buyer they're representing and warranting, and they're responsible for. The buyer has the opportunity to claw money back if they breach these reps and warranties. So the seller called me after that call and he said that was the worst call I've ever been on in my life. 2 hours to talk about reps and warranties. So it is a painful but necessary process. Deal killer, financial surprises, right? Anything that comes up that doesn't validate what you've told them or creates doubt or suspicion, is problematic. The customer concentration, the owner dependence. You told them that the business doesn't need you, but then they found out that you actually had a satellite phone on your cruise. You don't have management depth underneath you, and so now they got to plug somebody in to run the business after they buy it. They thought they were going to be able to take one of your employees and elevate them. So now they got an expense to go hire a manager that they hadn't calculated into the deal. So they're going to come back and try to retrade it, right? And say, well, the numbers changed. Declining performance, unrealistic expectations. Deals rarely fail because buyers lose interest. They fail because risk becomes visible to them. And that's my point, that you're really, from the time you sign the LOI, all the dynamics, all the leverage, all the control changes, and you're just trying to mitigate that risk and tell them they're
Right.
wrong in what they perceive, and really just validate, what you're telling them. Why they perform the Q of E, I think that's kind of self-evident. I will tell you, in the last couple of deals I did, the Q of E was not only used internally by the buyer, but it was presented to the lender. And so it wasn't just the private equity firm that was using that to sort of justify to their investors and cover their bases that, yeah, we did all our homework. We had a Q of E done by a reputable firm. Their lender is actually in receipt of the Q of E and using it to back up their loan as well. They're just making sure that they're mitigating risk and they understand the business. The Q of E itself rarely creates problems; it just reveals problems. I will tell you that there are bad actors in private equity. There are also some really good actors. I think the industry as a whole is sort of seen as this, Darth Vader type of character that swoops down,
Hey,
trying to
ma'am.
take. Yeah, generally speaking, all of my clients selling to private equity want to sell to private equity because they realize they're their best buyer financially, but they just have this fundamental belief that they're bad people that are out to screw them in this transaction. And sometimes that's true, and a lot of times it's not. There are a lot of really good, fine people there. I have had a private equity firm that will come in with an LOI at a number, and then they use the quality of earnings to retrade the deal. There are times when things that come up in the Q of E are legitimate
Mhm.
and there deserves to be a change. And there are times when they're just clearly using it as a tool to renegotiate a transaction they've agreed to. All right, 4 out of 5. What's your biggest concern about a future sale? Not sure what buyers will find. Yeah, sure. I don't know what I don't know. What are they going to find when they start looking through all my stuff?
Right. Checking the
Financial
different.
legal surprises, customer
Well,
concentration, owner dependence.
while they're answering that, I know we're coming up on 10 minutes, so we can keep powering through. If anybody has any questions, please feel free to enter them into the chat. Um, but it looks like you have a couple more slides here, so I want to
Yeah, let me see where I am.
good quality. We got some good quality stuff here, so I don't want to cut it short.
Yeah, I'll go a little more quickly through these. You probably have maybe one of each of these on the call today. I'm not sure.
Yep.
I will just say that I love working in teams. I've got a brother-sister legal team that I've worked with on a couple of deals that I really enjoy working with. A lot of times I'm working with new people on every deal. A good M&A attorney is just essential to the transaction. A good CPA can really support the Q of E and the other processes and anything they can do before the exit, right? The wealth advisor, the attorney, the CPA, the fractional CFO. I look at myself as being part of a team of people. And when everybody is capable and qualified that's working on that team, it's a beautiful thing. If you have an attorney who's never worked an M&A deal, it can be a terrible thing, or an M&A advisor that isn't really qualified to work the deal. It can get really, really problematic. And so it's great to be part of good, solid teams of professionals. And each
And
of them kind of sees
there
things
was
differently.
there was one question. This was the question I really wanted to ask was with when you're talking about teams, who's bringing the teams together? Is it somebody that the business owner already knows? Is it you? Are they asking you, hey, do you have a good attorney? At what
Yeah.
point does kind of everyone come in and at what stage?
Yeah, it really varies deal to deal. One of the one of the challenges oftentimes is that, and I'm not picking on attorneys, but a lot of times we have our corporate attorneys that, handle our basic legal stuff, and so, I'll work with the business and they'll bring that attorney in to run the deal, and an M&A transaction with a private equity firm is a really specialized transaction. And I use the analogy, you don't go to the podiatrist if you need open heart surgery, right? And
Right.
and and so that was terrible to turn attorneys into podiatrists. I'm sorry, and I'm sorry to the podiatrist if I offended them as well. But having people that have relevant experience is important. I will tell my clients that at the outset. Do you have an attorney? Do you have, who's your accountant? And so I will make recommendations.
Mhm.
It's almost universally those recommendations are on the legal side because they've just never done an M&A deal before, so they don't have an M&A attorney.
Right.
And again, those are specialists. Generally speaking, they have a CFO, they have a CPA, they have a wealth advisor. I get calls from wealth managers every day who want me to send my clients to them, and I'm like, they have wealth advisors, right? They have attorneys, they have accountants, they have wealth managers. They don't usually have M&A advisors, right? Because they don't need
Yeah.
them until they do a deal. But um, I would say that the cast changes with every play,
Okay.
for the most part. Um, and my biggest recommendation is usually to get a good M&A attorney.
Yep.
It's just more about the team there. CPAs help with the reporting quality, normalizing adjustments, improving forecasting discipline, highlighting trends and risk. Wealth advisors help them prepare for liquidity, do tax planning, post-sale financial planning. There's a lot of value that can be added by CPAs and wealth managers up front. Um, Attorneys, their role in the transaction is pretty obvious in terms of strengthening the contracts and resolving
Yep.
issues. And for me, I'm positioning the company with the right buyers, creating competition, negotiating the structure and terms, and managing to closing. Um, the more time you have, the more things you can do. If you start 5 years ahead of time, you can really work on owner dependence, management depth, reporting. If you start 1 year ahead of time, there's still things you can do to better position your business. The more prepared you are, the better the outcome's going to be. Uh, I'm getting to the close here, and our time is running out. I will say that the majority of transactions I do are not an outright sale of the business. The majority of transactions I do in the business this size are what's called a recapitalization. The last 5 deals I've done, the sellers retained part ownership of the company for what we call the second bite of the apple. The private equity firms love that because they like to have an alignment with the sellers, owners. Sometimes the owners stay on in, to continue to operate or in a different role. Sometimes they exit, but they still have an equity position. Um, I had a client recently who sold the 20% back end and a subsequent transaction for a deal he did 5 years ago. He got more for the 20% than he got for the 80% 5 years ago. So with the right partner, it
Yeah,
can work out really, really well, but it all comes down to the quality of that partner.
right.
But there are lots of different things here: family transfers, ESOPs, internal successions, the recap, and just an outright sale. Um, my five key takeaways: profitable businesses and sellable businesses aren't always the same thing. Most businesses that go to market don't successfully transact. I'm sorry, that's a terrible statement, but it's true. You
Truth
can't
hurts.
take you can't take for granted that your business is going to sell.
Hmm.
Buyers pay for predictability, transferability, and growth. Diligence rarely creates problems, it uncovers them. And preparation improves both valuation and the probability of closing. All right, race to the finish line.
Absolutely. This was great. I mean, I'm so glad we got there. I think this information was, there was, at least for me, the great golden nuggets in there for me to start thinking about when I'm speaking to some of our business owners and for them to consider. And also, for the audience, Lane just finished book number 2. So that'll be coming out later. That's more on the platforms-based business that private equity is looking for, right, Lane?
Yeah, it's called the Platform Premium unless my publisher changes the name. And so, Optima Advantage is for anybody that has a business 10 to 100 million, and it takes them through the sellability assessment and then says, if you're ready to sell, here's what that process looks like. The
Right.
Platform Premium is if you got a couple of years of gas left in the tank, you're willing to work on your business. You can get another 1 or 2x on your valuation if you build a platform. Here's how to do that.
That's great. That's fantastic. And I'd also throw out there that I think that this book is great for anybody who's in an advisory or consulting position to a business owner that's even thinking about selling. So our CPAs out there, our controllers, our CFOs, just to have a general idea of what a business owner can expect and to help guide them and consult them through the process. I think it would be very beneficial in that capacity. So this has been fantastic, Lane. I so appreciate you presenting to us in person and then here now. I think this information is invaluable to all those online. I believe these slides are accessible under the resources if you guys wanted to look back over and then go check his book out on Amazon and add it to your summer reading list.
You'd have to be pretty bored, or you'd have to be a business owner that's interested in selling, right? If
Yeah,
I
I
see
don't know.
anybody
I
with it on
mean,
the beach, that'll scare me. But you
no
know,
way.
but thank you,
Oh,
Alex.
that's
It's
great.
an honor
Absolutely.
for me to present to your folks, and I enjoyed meeting you and Darla and being in your office. And any questions that come up, feel free to reach out to me. I'm happy to engage with anyone and answer any questions.
This is fantastic. Well, thanks so much. Thank you all for joining, and we will see you on the next one.